Hey everyone, welcome to our video. Today we have really a great topic that I think this is such a good topic because it's one that I think so many people think about it maybe the wrong way. But what we're talking about is risk in your portfolios. And so I'm looking forward to our conversation. Hopefully, we'll look at risk from a slightly different angle than you've been looking at it, and maybe reframe the way you think about it a little bit. So let's get started. But I'll start with I'm Cary Smith. I'm sitting here with Amar Shah. We're both with Client First Capital. And so, Amar, why don't you get us started on this topic?
Yeah. The big idea here, Cary, is everybody is chasing a good return. Nobody is not chasing a good return, right? Like the only difference that, from our perspective, is how much capital are they willing to put at risk, right? So the difference between a conservative investor and an aggressive investor is really, in our view, is how much capital are they willing to put at risk. They both have the same underlying holdings, investments, but how much do they have in those investments? And man, I got to tell you, it's a long road getting to where we are today with our views on risk. And I started out as an advisor in 2004, and when I started out, we had a 30 question survey that we would give clients to figure
Yeah.
out their risk tolerance, right? And after answering those 30 questions, how fast do you drive if the speed limit is 65? How much can you afford to lose in a 3-month period, knowing what you would get back 12 months later? A bunch of different questions. Then fast forward a couple years, um, the industry went to give me a score from 0 to 100. Where do you feel comfortable, right?
Yeah.
In terms of how much risk that you feel that you'd like to take. And then where we both worked at USAA, we actually just asked one question: how much can you afford to lose,
Yeah.
right?
Right.
and then we figured out a portfolio based off of downside risk. In fact, in 2019, when I started this firm, when my compliance department, if you will, they gave me a 7-question survey, right, of what is risk. And you got to understand the industry looks at risk, standard deviation, volatility, charts, all this jargon, uh, and probably confuses people on the other side of the conversation, right?
Yeah,
So
I think investors look at risk a little bit differently, right? And so they look at risk maybe through the fear factor or the panic factor, or am I going to have enough, right? And so very different than the analysis that the industry does, right? It's
yeah,
a little more reactionary.
yeah, and I would say like all those questionnaires and stuff, like the reality is that like you know, investing in a house, your primary residence, that's a risky investment too.
Hmm.
House prices don't always go up, right? Like
Right.
it's volatile. It's just with the investments, you see a mark to market or a statement or monthly, you can see how much it went up or down on a daily basis, which could be
Yeah.
troubling for some. And it ignores the context of your goals, timelines, options that you may have, and it could probably add an element of additional risk, right? So when we think about it conceptually, conservative means low stocks, high bonds. Aggressive traditionally means high stocks and low bonds. Well, if you're a conservative investor and you have a lot of bonds, bonds also has risk and risk associated to it, right? Like I'm not talking about like 3 years or less bonds, but if you invest in bonds that have a greater maturity than 3 years, you are taking on interest rate risk. You're taking on credit risk. You're taking on, uh, you know, several factors with bonds in terms of duration, right?
Hmm.
As well. So there's like a lot of complexity with bonds itself that would add layers of risk. Vice versa, if you're an aggressive investor and you have a lot of stock, right? Stocks also have risk, right? And I would argue that if you ask an aggressive investor that says that they're aggressive, and you gave them a probability that, let's say, there's a 60% chance that you're going to lose money in the next year, I don't know if they would be as aggressive as they think, right?
Right.
So the traditional risk tolerance modeling has some biases of the actual investor. So if we just lost a bunch of money, you're not going to be as aggressive as you really are, right? Or if we know that there's a probability of losing money, you're probably not going to want to take on as much risk, right?
Right. I'm gonna defend the risk questionnaires for just a second. And
Sure.
so if it's a 30 question that you got back in 2004, or the 100 questions, or how much are you comfortable losing, regardless of where you get to with understanding a person's risk, it now becomes very clear to them that there is risk,
Yes.
right?
Yes.
And that's important for people to understand. And so regardless of the outcome or the tool, having that conversation, I think, is important. It gets people thinking about the downside and not just the upside. And it is kind of a nice reality check of what they're doing. And so that's all I need to say about that. I just wanted to kind of defend that process a little bit. I know
Yeah,
you're
sure.
favorable of it also, but
Yeah. I'm not trying to beat up on it, but
right.
like I think a good deal of risk management, I would say, is to realize that you are taking risk.
Mm-hmm. That's
Right.
right.
There's no guarantees, right, with investments and so forth. But I think what the focus should be on when we're looking at risk is two factors. One is willingness and ability to stomach the volatility, the ups and downs, and your personal emotions. And then the second factor I would say is ability to take risk, right? Can I afford these losses and still stay on track to my goals, my charitable giving, my travel plans, my et cetera, right? Whatever is meaningful to them, right? And so what we do is we kind of look at both of those from a lens of financial planning. What is your ability to take risk based off of what you've described as your goals and concerns? And then willingness on an emotional basis, like how much of your portfolio do you want to not have to worry about, or that you can sleep at night knowing that you have X amount in low risk, consistently conservative type investments, right?
Right.
And I think the analogy I would give is that, when you're driving from point A to point B, everybody wants to get there in a timely fashion, right? But some people drive sports cars and some people drive SUVs with a little bit of extra steel and airbags and safety features that to get there, right? And so what we need to define is that if we can get there from a planning perspective, will you also feel comfortable from an emotional perspective?
Right.
And so how we define this and how what we look at really is to define two separate portfolios. One that's going to take on risk and one that's consistently conservative and low risk, cash-like instruments, defined outcomes, low volatility, steady outcomes, high predictability, combined with a portfolio that is, has volatility associated to it, right? And when you combine those two, you get the ideal portfolio for a client. The low risk cash like investments is safe. You can sleep at night. The volatile investments is where we're going to get the long-term growth. And so when we look from a planning perspective, if we don't need to take on a lot of risk, we're not buying a bunch of bonds. We're just trying to figure out what percentage do we need in that safe account versus taking on risk.
Right.
And then when we do take on risk, we're looking at what is the best risk-adjusted return for the current environment.
Okay.
So looking.
So Amar, we ask questions to understand risk. What are questions that maybe an investor should be asking, right, as it pertains to this? And I think where I'm going with this, I think you touched on it a moment ago, but the questions they ask kind of frame how they should be looking at risk. And I've got an example, unless you just want to jump in.
No, go ahead, and then I'll add.
Okay, so one question that you might ask to understand is, what am I trying to achieve, right? And so the answer to that question, I think, is imperative to understanding, you know, where you want to be from a risk perspective. You said this earlier, how much can I afford to lose? Maybe is another question that a person could ask themselves. So anyway, let me just pause there. I've got a couple more questions I can
Yeah.
throw in there, but I think they're all along the same lines.
Yeah. What am I trying to achieve is a great question, because I oftentimes find individuals that are in retirement want to be very conservative.
Right.
Right. But they haven't really put pen to paper on what do they want to achieve. And what they realize is that being so conservative, could probably impact me 10, 20, 30 years down the road in terms of ability to spend, but also impacts my lifestyle now. Because you're so conservative, you're not getting that growth that you need to take those extra trips, those extra things that you want to do, you know, your next best decade, your wish list, being able to achieve those because you want to have low risk.
Yeah.
Right?
Let me share how I look at it. Right.
Yeah.
And so here's what I want to achieve, but this is also similar to what I hear from a lot of other people. I want to have enough money to get me all the way through retirement. I want to live a comfortable lifestyle between now and then. And given those circumstances, I want the best return possible.
Yeah.
So that's what I'm trying to achieve.
Yeah. Yeah, exactly. And so to do that, and this kind of goes into how much can you afford to lose, you have to ask yourself, how much runway do I need before my emotions will start to kick in? And kind of the process that we use with clients is to see, all right, this is your monthly expenses. This is how much is covered by stable sources, which are like pension, social security, etc. And so how much gap are we trying to cover? Right now, how many months of that gap do you need to cover before you feel like the markets could change? I will tell you, for most people that are in retirement, that could look like 1.5 to 3 years. You know, average market bear market, a secular bear market could last 3 years, right? So some people have 3 to 5 years worth of those expenses that they need to cover that gap in a very conservative cash, short-term bonds, CDs type ladder, high liquidity, defined outcome type solutions. And then the rest, we're trying to get the highest return per unit risk. And so that's the process that we use. You know, I think things change over time too, where people will say like, hey, I was comfortable with this amount of safety net, but now the markets are going up and I feel this safety net's a drag. So there's like a reminder or a process to go through. You know, it's not like a one and done. It's like you have to revisit. And then sometimes if the markets go down, you realize, hey, that safety net, I know it's going to cover me for 3 years. I need something that covers me for 5 years, right? So that I can really just sleep at night. And so it's good to kind of revisit your risk on an ongoing basis.
Yeah, that's right.
Yeah. And don't get defined by labels of aggressive or moderate, right? It's this is my safe part of my accounts, right? And this is accounts that I'm taking risk on. And I want to get the highest unit of return per unit of risk, right?
That's right.
And that's where the focus should be.
So risk management is not about avoiding risk, right?
Right.
It is about, and then I'm going to ask you to finish that sentence for me.
It is about aligning the part of your portfolio that you're taking risk with to a purpose that's driven by your financial plan, right? So how do you want the next decade to be, in solving that, as well as making sure you have enough money for the rest of your life.
That's right.
Yeah. I think that's a good place to end it, Cary.
Yeah. So Mar, but I appreciate this discussion. I also appreciate you just kind of let me freeform some questions to you throughout this video, because because I think that as we approach this video, I'm thinking of it about my portfolio and my retirement, and which is very similar to what I hear from our clients. And so, so it's just a very, very practical, I want to have a good retirement, right? Is my approach to risk. Okay. So let's do this before we end.
Okay.
So if you're out there and you're watching this video, if you care to share a comment, maybe share with Amar and I what's the best risk you've ever taken in investing.
That's great.
So share with that, and we'll look for those responses and hopefully have some really good dialogue with you through those responses. And then, but before we close, Amar, any last thoughts?
Just hit the like and subscribe button so other people can find our content just like you. Thank you for watching.
Thanks for watching, everyone. Also, just real quick, if you would like to have a free financial consultation, just reach out to us on our website. You can find us at clientfirstcap.com. And from there, you can schedule an appointment with someone or give us a call if that's what you prefer. Thanks for watching.
Bye.
See you.